$185 billion.
Hmm.
I just want you to sit with that number for a second.
Mm.
That's not the GDP of, a country like Qatar.
Not even close.
That is the estimated budget for one company, Alphabet, to spend on equipment in 2026.
It's a number so large it almost loses its meaning, doesn't it? It's nearly double what they spent in 2025. And frankly, that single number is kind of the gravitational black hole that's pulling every other story we're talking about today into its orbit.
It really is. Welcome back to the Deep Dive. It's Wednesday, February 4th, 2026. I was reading through the stack of earnings reports this morning, Alphabet, Qualcomm, the pharma giants, and at first it just looked like a busy week.
Just another earnings season.
Right. But when you layer on the macro data, with housing and all the geopolitical noise, a very specific picture starts to form.
It's a picture of a massive reallocation. I mean, we're not just looking at profit and loss statements today. We are looking at a fundamental shift in where money and electricity and even raw manufacturing capacity is flowing.
Exactly. So today we're going to break down how Google's spending spree is accidentally strangling the smartphone market. We'll look at why hedge funds are betting billions that old software companies are basically walking zombies.
And we have to talk about Big Pharma. I mean, it used to be a tie between Eli Lilly and Novo Nordisk. That truce is effectively over. Plus, we'll get into the Greenland gambit that's affecting Bitcoin and see why 6% is suddenly the magic number for homeowners.
Okay, so let's start at the top. Alphabet, Google. They reported Q4 earnings, and the headlines were a blowout. Revenue hit almost $114 billion. They beat estimates. Google Cloud up 47%.
All good news.
But I feel like the market barely even cared about the revenue. Everyone was obsessed with the cost side of the equation.
Right, because for a company that size, revenue growth is one thing, but investment signals the future. That $175 to $185 billion CapEx guidance, that's the tell.
It just feels less like efficiency and more like an arms race.
Yeah.
What are they actually buying with that kind of cash?
It's almost all infrastructure. We're talking custom silicon chips, massive data centers, and the energy grids to run them. Google is basically saying that the demand for AI compute is infinite, so they're going to spend what feels like an infinite amount of money to capture it.
But the world isn't infinite.
That's the problem. The world is finite.
And this is where the story gets really interesting and a little concerning for the average person. I was looking at Qualcomm's earnings, which also came out. On paper, they did great. $3.50 per share, beat expectations, but the stock tanked.
And you know what that means. When you beat but the stock drops, it's all about the guidance.
It was ugly.
It was. Their CEO, Cristiano Amon, he practically waved a red flag on the earnings call. He admitted a global memory shortage is capping their ability to sell chips.
Okay, so connect the dots for us here. How does Google spending $185 billion on AI servers hurt Qualcomm, which, makes chips for my Android phone?
It comes down to manufacturing capacity. Think of the global supply of silicon chips, like a pizza. It's a fixed size.
Okay, so the pizza has 8 slices.
Right. And right now, the AI data centers, Google, Microsoft, all of them, are screaming for high-performance memory. They're willing to pay a huge premium for it. So the chip manufacturers, the guys making the pizza, they're dedicating almost all their slices to making that high-end server memory.
Because that's where the money is.
That's where all the profit is.
Which leaves the smartphone makers fighting over the crust.
Essentially, yes. It's a zero-sum game. Amon's quote was really stark. He said, "Memory is defining the size of the mobile market." He's saying they could build more processors, but there's literally no memory to pair them with.
So if I'm planning to buy a new phone this year, what does this actually mean? I'm just not going to find one on the shelves?
Oh, they'll be there, but the mix is going to change. Because memory is so scarce and expensive, phone makers can't afford to put it into cheap phones. There's no margin.
So they're going to shove everything into the Ultra or Pro models.
Exactly. We're entering a forced upgrade cycle where if you want a decent phone, you're going to have to pay premium prices because that's the only place the good components even exist.
So the AI revolution is being subsidized, in a way, by us paying more for everything else.
That's a cynical but pretty accurate way to look at it.
Speaking of cynical takes, let's talk hedge funds. I saw a statistic this morning that just blew my mind. Hedge funds have already made $24 billion in 2026 betting against software companies.
It is the short of the century right now. The main software ETF, the IGV, is down 21% year to date. That is a bloodbath for a sector that used to be the darling of Wall Street.
But who are they targeting? I saw Intuit, the TurboTax people and DocuSign are down over 30%. These are profitable companies. Why are investors betting they're going to zero?
They're betting that their business model is structurally obsolete. They call them falling knives. But a better analogy might be, buggy whip manufacturers right when the Model T rolled off the line.
But wait, isn't that a bit premature? I mean, I use AI, but I wouldn't trust it to just file my taxes for me. Intuit has this massive moat, right? Regulation, trust, habit.
That's the big debate. But the short sellers argue that software as a service, the whole SaaS model, is being replaced by service as a software.
Okay, unpack that for me. What's the distinction?
So Intuit sells you a tool, the software, so that you can do your taxes, which is the service.
Right.
The hedge fund thesis is that AI agents will just do the taxes. You won't need a tool, you'll just need a result. If an AI built into your operating system can organize your receipts and file the forms for free, why would you pay Intuit a subscription?
So they're betting that basic automation tax prep, signing a document, is becoming a commodity. The price is just going to zero.
Exactly. And that's why all that money is fleeing those stocks and moving into the companies building the AI. It's a brutal rotation.
Wow. It's not just that the tech is improving. It's that the value of the software itself is collapsing. Speaking of value, let's look at the pharmaceutical industry.
The GLP-1 weight loss wars.
For the last few years, this was the Coke and Pepsi of pharma. Eli Lilly and Novo Nordisk. You bought both, you made money. But looking at the guidance this week, that relationship has completely fractured.
It really has. We're seeing a massive divergence. Eli Lilly is forecasting its 2026 sales to jump 25%, up to about $83 billion.
Okay.
Meanwhile, Novo Nordisk, the pioneer with Ozempic, is warning of a sales decline of 5 to 13%.
That is a staggering gap, a 30-point swing between the two. Is this just marketing, or is there a real difference here?
It's the science. The market is realizing that Lilly's drug, tirzepatide, is just clinically better than Novo's semaglutide. In the head-to-head trials, the weight loss is more significant with Lilly, and doctors read those studies.
Sure. But there's also the big leap coming, right? The oral pill. Everyone hates injections.
That is the holy grail. But this is where you have to get a little technical to see why Lilly is winning. Novo has an oral pill, but the user experience is terrible. You have to take it on a completely empty stomach. Then you have to wait 30 minutes before eating. You can only drink 4 ounces of water. No more, no less.
That sounds like a religious ritual, not a medication. Why is it so fussy?
Because it's a peptide. Peptides are fragile. Your stomach acid exists specifically to destroy them. So it's incredible. Well, Lilly is playing a volume game. Their CEO pointed out that Medicare coverage for obesity treatments kicks in this July. That opens the door to 40 million new beneficiaries.
40 million. That's a massive customer base.
Huge. So Lilly's bet is, we'll take a lower price per pill, but because we have the better, easier pill, we'll capture most of those 40 million people. Novo is looking at that same math and realizing they might lose the volume war and the price war.
Absolutely ruthless. Let's zoom out from the companies to the macro picture. The stuff hitting our wallets. We finally have some movement in housing.
We do. The 30-year fixed rate has dropped to around 6%. It's a big psychological break from the 7-8% world we were in.
And this wasn't just the market, right? This was a policy lever.
Yes, this was driven by the government's plan for Fannie and Freddie to buy $200 billion in mortgage-backed bonds. That's a massive injection of liquidity into the market.
So at 6%, who does this actually help? Because I know a lot of people are sitting on 3% rates, and they are never, ever moving.
Right. The lock-in effect is still very real for the 39 million people with rates under 5%. But the data shows that at 6%, about 5.5 million other homeowners can now financially justify refinancing.
That's millions of households that might save a few $100 a month. That's stimulus.
Exactly. It greases the wheels of the economy a little. It doesn't solve the inventory problem, but it helps.
Now, usually when liquidity enters the market, risky assets go up. But Bitcoin is having a terrible week. It's down near 72,000. It was at 126,000 just a few months ago.
It is bleeding out. And this is a case where geopolitics is overriding economics. You've probably seen the headlines about the Greenland Gambit.
I have, but let's explain it. It sounds like a spy novel title.
It does. Essentially, there are renewed diplomatic maneuvers by the U.S. to purchase Greenland. And this has caused, let's say, significant friction with Denmark and the EU.
And markets hate that kind of fiction.
Precisely. Usually when fiat currencies get shaky, people run to Bitcoin. But in this case, the tension is between the major Western powers. It's creating a risk-off environment. Investors are scared, so they're selling the most volatile thing they own, crypto.
And on top of that, we have uncertainty at the Fed with President Trump nominating Kevin Warsh for chair.
Right. Markets are trying to figure him out. Is he a hawk? Is he a dove? That uncertainty just adds to the selling pressure. Plus, the ETFs have seen billions in outflows since November. The institutional money is leaving.
So a tech supply crisis, a software sell-off, a pharma war, and geopolitical tension. Let's try to hit a couple of quick hits before we wrap. Something that caught my eye was the shuffling at Amazon.
The shadow.
CEO Andy Jassy picked Dharmesh Mehta as his new shadow advisor. This sounds like a glorified assistant, but at Amazon, this is a big deal.
It's the most important personnel announcement of the year there. Being the shadow is the CEO training ground. Jassy was Bezos' shadow.
So why Mehta? What does this tell us about where Amazon is headed?
Mehta is a logistics and international expansion veteran. He's the guy who fixes messy operational problems. By picking him, Jassy is signaling that Amazon's next phase isn't just about new ideas, it's about ruthless operational efficiency. It's a signal that the machine is going to get even tighter.
Always read the personnel moves. Okay, finally, energy. Oil prices jumped 3% to over $65 a barrel.
This is the Iran risk premium coming back. President Trump said the supreme leader should be very worried after some recent drone incidents.
Saber rattling.
The market thinks so, but it can't afford to be wrong. Traders immediately priced in a disruption, but there are talks scheduled in Oman this Friday to try and de-escalate. If those talks go well, oil will probably drop back down. If they don't, well, 65 might look cheap.
All right, we have covered a massive amount of ground, but I want to circle back to the very beginning to tie this all together.
The theme today really is constraints.
Hold on.
We spent the last decade in a world of, abundance. Abundant cheap software, abundant capital. Now we are hitting walls.
The wall of manufacturing capacity for chips.
Right. Google throws $185 billion at AI, and suddenly Qualcomm can't get memory. We're seeing a reallocation of the physical world to serve the digital world.
And in software, a reallocation of capital away from dumb tools to smart agents. And in healthcare, away from hard-to-take biologics to easy-to-take chemistry.
It's a flight to quality and efficiency. The market is punishing anything that's second best.
Which leads me to a thought I've been mulling over since you mentioned the energy demands of those data centers.
I think I know where you're going with this.
We talked about memory chips being the bottleneck of 2026. But those $185 billion worth of servers, they have to plug into something.
And the grid is already strained.
Exactly. So here's the question for you to think about. If AI is eating the silicon supply today, is it going to eat the energy supply tomorrow? Are we heading toward a future where big tech has to buy power plants just to keep the chatbots running?
It's a terrifying but plausible thought. Are we just looking at an energy crisis disguised as a tech boom? If Google and Microsoft need 20% of the grid, what happens to the price of electricity for your own home?
The next scarce resource might not be the chip in your phone, but the power to charge it. On that cheerful note, thanks for listening.
Keep looking at the numbers, everyone.
We'll see you in the next deep dive.